Hello, today we're going to be talking about government microeconomic intervention. The speakers today will be Grace, Patrick, and Jason. We're going to be talking about indirect taxes, direct taxes, and especially subsidies, how government can intervene into other countries.
So first of all, we're going to discuss about indirect taxes. Indirect taxes are those taxes which are levied on spending, which is goods and services. Indirect taxes are collected by the seller on behalf of the government. Its main objective is to discourage the consumption of demerit goods. A good example would be imposing indirect taxes on cigarettes. As you may know, cigarettes are demerit goods. There are several examples of indirect taxes, like specific taxes, ad valorem taxes, custom duty, and even service taxes. Ad valorem taxes refers to whose amount is based on the value of a transaction or of property. It is typically imposed at the time of a transaction. Meanwhile, custom duty refers to the tax on the importation, usually, or exportation, unusually, of goods. Imposing indirect taxes have three benefits. First of all, it is convenient to pay. Indirect taxes are wrapped up in the price of commodities, so they are very convenient to be paid at the time of purchase without even feeling the pinch of tax payment. Secondly, indirect taxes cannot be evaded. Indirect taxes cannot be evaded as they are included in the price of commodities. Third of all, indirect taxes are more flexible than direct taxes. This is because the rate of indirect taxes can be changed at any time when and where necessary. Lastly, indirect taxes have a wider tax base. Indirect taxes are imposed on all irrespective of whether they are young, old, employed, unemployed, rich, or poor. However, there are three disadvantages of imposing indirect tax that should be considered by the government. The first one, it is unfair. Indirect taxes are regressive in nature. It means the poor has to pay a higher proportion of his income than the rich. Therefore, it is very unfair. Second of all, indirect taxes can lead to inflation. Indirect taxes are included in the price of commodities. The higher the rate of indirect tax, the higher the price of the product. Last but not least, indirect taxes are uncertain. It is difficult to estimate the actual volume of the consumption and the amount revenue it will raise. And now we're going to discuss about tax incidence. Note that in the four diagrams below, a tax on a particular product increases its price and decreases the quantity supplied. Since suppliers are getting less revenue for the product, the assessed tax shifts the supply curve upward. From S to ST, the price increases from P to QT, and the quantity declines from Q to QT. But how the tax incidence, or the tax burden, is shared between buyer and seller depends on the elasticity of both demand and supply. The buyer bears a greater portion of tax burden when either demand is inelastic or supply is elastic, as shown in diagrams number 1 and number 4 respectively. When demand is elastic or supply is inelastic, then the seller bears the major portion of the tax, as shown in diagrams number 2 and number 3 respectively.
Next is the direct tax. First of all, what are direct taxes? This kind of tax is a tax that is directly imposed on the incomes of people and firms. This is highly different than the indirect taxes, since indirect taxes are imposed on goods and services. Direct taxes are also unavoidable since the people that are economically active must pay their taxes. There are two types of direct taxes. First, the income tax. The income tax are imposed by the government on individuals that varies according to their incomes. Second of all, corporation tax, or company tax, is imposed on the income or capital of some types of legal entities. There are also advantages of direct taxes. First of all, it's certain. In this case of direct taxes, the taxpayers know how much they must pay and when it is due. The government also knows exactly the amount they're earning, since they know what to expect. This reduces the corruption from collecting officials. Second of all, it's elastic. If the country needs more fundings in the times of emergencies, the direct taxes can be used. The yield from income taxes can easily be increased by raising their rate. Third of all, it is productive. When the community of the country increases in numbers and prosperity, the return from direct taxes expands automatically. The country can then have a larger revenue. Direct taxes also have some disadvantages. First of all, it's inconvenient. As you know, the taxpayers must pay the authorities, and a large sum is being taken out of their pockets. It becomes very inconvenient to pay. Second, it's evadable. The assessee can submit a false return of income and thus evade tax. There is a lot of evasion. Many of those who should be paying their taxes go scot-free by concealing their incomes. Third, it is arbitrary. If taxes are progressive, the rate of progression has to be fixed arbitrarily. If proportional, they fall heavily on the poor. Besides direct taxes and indirect taxes, there are also other types of taxes, like proportional tax. Proportional tax is when the income rises, the proportion of income paid in tax remains the same. The tax rate is therefore constant. Proportional tax, to make it simple, is one that takes the same proportion or percentage from all who has to pay them. While the second, progressive tax, are those when the income rises, the proportion of the total paid in taxes increases. The average rate of taxation will therefore be lower than the marginal rate. Third, there's the regressive tax. Regressive taxes are those that as income rises, the proportion of total income paid in tax falls. Hence, the average and the marginal rates of taxation are falling.
Subsidy. It is an amount of money given directly to firms by the government to encourage production and consumption. The purpose of subsidy is to keep market prices of necessities low and to encourage the consumption of merit goods. Example of subsidy will be subsidizing staple foods and public transport. Looking at the graph, a good and or service meets its market supply and demand curve at an equilibrium point E. The original price is at P and original quantity at Q. When subsidy is paid to a producer, there is a fall in cost for the producer and result in a rightward shift in the market supply curve, as shown on the line S to S1. Price falls from P to P1 and quantity increases from Q to Q1. This is because when price falls, it means the price of goods are cheaper and the cost of production are cheaper for producer. This caused the quantity to increase from Q to Q1. Rectangle CAFP is the amount of subsidy enjoyed by producer, and rectangle PFBP1 is the amount of subsidy enjoyed by consumer. C is when price is without subsidy. This is because producers can actually sell their products at price C, but because subsidy is given, price falls to P1. The amount of subsidy per unit is from price C to P1, and the total amount of subsidy paid by government is subsidy per unit times the new quantity, which is Q1, or the area of rectangle CABP1. When subsidy is given, supply curve shifts to the right from S to S1. There might be a loss of subsidy, as shown at triangle AEB. This is the loss of economic efficiency due to market failure. In the case of subsidy, it is not enjoyed by any party.